Welcome back to the Retire Young radio show. I am your host, Joshua David. Always having a great time in studio talking about the financial markets, how they work, and helping us in America with that financial literacy. Also, don't forget to subscribe to the Retire Young podcast on Apple Podcasts, iHeartRadio, and Spotify. Al, as we get into this next segment, I had mentioned earlier, I want to get into how price really moves, how it moves up into supply zones, how it moves down into demand zones, and all this price action is really caused by the institutions, the financial, the Wall Streets of the world, the Buffetts, the big and the smart money. But they are always creating income, and the problem is the public typically isn't. And there, we talked about those common mistakes that the public makes in the first segment. I want to dissect that a little bit more on how the smart money is creating income. But let's first, before we do that, let's talk about supply and demand. How that really works in the financial markets is exactly how it works in pretty much everything in life.
Yeah, really, the supply and demand is that relationship is a fact that really can't be argued, and it happens in every financial situation. When there is more demand for something, price is going to go up, and when there's more supply than demand, price is going to go down. In the markets, financial markets, we're talking about buys and sells when we talk about supply and demand. And in every market, the origin of any move in prices is where supply and demand is out of balance. In other words, when you have an equal number of buyers and sellers, price really isn't going to fluctuate very much. But all of a sudden, when a huge number of buy orders enter any market, price is going to go up. And the same thing will happen when a huge number of sell orders enters the market. But in the financial markets, it has to be done in such a large way that we can see it on a price chart. And that always happens when institutions or big players, could be a big hedge fund, takes a position either to enter a trade or exit a trade. And how do we know that we can identify where that's going to happen? Well, our strategy, everybody should have a foundational strategy that they use, something that they use on a consistent basis. Our students use what we call core strategy, which is our core strategy. And what it does, it relies on the fact that these big traders, the smart money, trade with such high volume, high numbers, high dollars, that they cannot get filled all at one time. Warren Buffett at one point in time, he wanted to take a position in IBM stock. He wanted to own 64 million shares. Well, IBM only trades around 3.5 million shares a day. So in order to get that order completely filled without kind of tipping his hand and having the price go way out of the range that he wanted to pay, he had to do it in increments. It took him almost 8 months to do that, get that full position filled. Institutions have to do it that way. They have to do it in increments. And then our core strategy is designed in a way where it kind of identifies where a subsequent trade is going to be made, whether it's going long, buying, in other words, or going short, selling. And that's what you need to do with a high degree of accuracy, because that's something that happens on a repeatable basis. The institutions are active every day. They always have been. They always will be. It's not something that just happens maybe once or twice a year or, without any kind of repeatable type of a situation. So that's how our core strategy works. It's that same basic strategy that you're going to use regardless of whether your interest and your goal is short-term trading and investing for income now or long-term building of your wealth.
Well, that's correct. I mean, even think of it as it's the same as the housing market. I mean, you look at the housing market right now and people are paying ridiculous prices because they're moving the price up. There's so much buying that prices continue to go up. And everything is based off a price chart. I mean, a lot of investors that struggle, they typically make their decisions off of what the news is telling them, what they read on the internet or the newspaper. Well, think about this. If you're seeing it on TV or reading it in the newspaper or in a magazine, when are you getting that information? It's late. The moves have already happened. So you're basing your decisions off a price chart because that does not lie. And you have to learn how to read that price chart. And that's what supply and demand really is the buyers and sellers, how to read that price chart, and then how to put the odds in your favor, as Al was talking about in the first segment, is having that edge. So real quick, Al, now the smart money, they're always creating income with the stock market. It's a great asset to utilize. That's why they use it. Mm-hmm. Now there is other markets out there as well, but a lot of the smart money likes to use all of them. So why would somebody, rather than just trade stock market, I know we have a lot of listeners that are trading the stock market. That's a great asset. But what are some of the benefits of knowing other assets?
Right. The stock market really is the best market for long-term wealth, for the buildup of long-term wealth, as long as you know how to manage a portfolio properly, which includes protection and also increased growth of that portfolio. But the institutions don't just trade stock because they're really the equity market really is more of a long-term type of a vehicle. For short-term trading, whether somebody is looking for a short-term income, maybe daily, weekly, or monthly, taking care of short-term needs. And most of us have that. I mean, it costs money to live. People have to have a place to live. They have to pay rent or pay a mortgage. There is property taxes if you own a home.
And just so everybody understands that, I mean, when we're talking about income, that's basically the net result. I mean, there is risk in trading,
sure,
but you want to minimize that risk on with a plan.
Right. Yeah. And that is probably the most important thing to do is to minimize the risk. The goal should be to maximize your reward and minimize the risk. And one of the ways that you do that is, as I mentioned in that first segment, you eliminate large losses. Only learn to take a small loss, and then also learn how to identify a quality trade that has a profit potential that significantly increases whatever the potential risk might be. Should be a minimum of at least 3 to 1. I think one of the mistakes people make, and one of the reasons that they kind of stay away from taking control of their own assets, is they think they have to be right all the time. And that is the furthest thing from the truth. Most of the pros out there, the professional traders, they're happy if they're right 40 or 50% of the time because they control that reward risk ratio. And that is one of the things that we teach our students. So if you're looking for a way to take care of your short-term needs, it can't be a long-term type of an investment. And that's typically what people are in, what Wall Street will put most people in, regardless of what their goals are, whether it's short-term or long-term. It's typically a long-term buy and hold portfolio.
Now, in these investing classes that you teach, I know you give more details on what that difference really is. When you mentioned short-term and long-term, it's just it's the same type of strategy. I won't say, I guess, maybe not the same type of strategy, but same type of trading, but a different time horizon. That's kind of what you're basing those decisions on. Now, you mentioned minimize risk. I want to talk a little bit about capital at risk. Mm-hmm. Now, we talk about the stock market, how great of an asset that is. Now, that requires your capital. You need to purchase the stock. You need it's required to have that capital in your account. Now, there's other asset classes that are a little bit different. Let's talk about that. Let's talk about the futures market and the Forex market on why they're so great to be traded with the stock market and not just the stock market.
Sure. Yeah. And there are different assets that are designed to complement different market conditions. And what we're talking about are leveraged assets, short-term trading assets. And one of the goals, or one of the advantages, I should say, with leverage is that you can use smaller amounts of capital to control a larger investment rather than putting up 100% of the cash. It's similar to a down payment on a home or a car loan or using your credit card. You have a smaller amount of money that's required up front to control something that has a much larger value. And it's basically a multiple of your investment dollars. So every dollar may control $10 worth of something, or a dollar might control $100 worth of something. That's actually just being more capital efficient. It's maximizing the buying power of each dollar you have.
So examples would be like the futures market and the Forex market.
Correct.
And the options market.
Yeah, those are the three primary leveraged assets that people have access to. And that's the important thing. You do have access to those things, even though your Wall Street advisor might be just talking to you about stock or those other things called mutual funds.
Hey, you're not supposed to swear on air.
That was a veiled one, I guess. But those assets are used by institutions pretty much on a daily basis. In the futures market, that's probably the go-to short-term trading vehicle, because typically you're in and out of a futures trade in a day, sometimes maybe within an hour or so. It's very well designed, I guess, for short term trading.
Just clarify a little bit, Al. A lot of people think that's day trading. That has a negative connotation to it.
Right.
It's just you're in and out of a position the same day, so you can pick that strategy.
Yep.
And if you get out of your trade the same day, great. Go to the next one.
Exactly. Do you care really if your profit potential is reached in a day or 2 days? Are you okay with that instead of waiting a year or 6 months for it? Probably your answer is going to be yes.
So that's what that strategy is designed to do.
Sure. And it really was, that whole market was put together for companies, big companies like Cargill and General Mills, so they could have a better idea of what their basic costs were going to be for grain. Airlines use it for jet fuel, for example. Farmers use futures contracts to lock in the price of a crop before it has actually been harvested. And we can do that as speculators or investors. We can use futures, and we can trade the major stock markets within the futures world. We can trade commodities. You can trade oil, gold, silver, currencies, interest rates, a number of different things. And the great thing is that there are components there that are really not correlated in any way. So you have the ability to have truly well diversified investments within the futures world. Plus, it trades almost 24 hours a day. So you have the ability to choose when you want to do it. A lot of people are locked up during the 6.5 hours that the stock market's open. Not the case with futures. The same with Forex. That is open 24 hours a day. That's where you're looking at the difference in exchange rates between two different currencies. That's traded as a pair.
So like the dollar versus the yen, the euro versus the dollar.
Sure.
Basically, you're trading one country against each other. Right? I mean, it's kind of the concept.
Against another. That's true. And typically,
or economy even.
Yeah, and I mentioned a lot of different things within the futures world, and now we talked about a lot of different components or combinations in Forex. Typically, what happens is that people, they get used to kind of developing a niche where you're going to pick just a few in each area that you will get used to and trade or invest on a regular basis. But most people are they're a little bit leery about trading futures or Forex simply because they don't know about them. They have not been educated. And, a big part of that education is understanding how they function, why you might use one in a certain situation over another, and then also making sure that you have a risk management strategy that is implemented at the beginning of a trade.
Well, the great thing is they're not new, like you said. They're just different. And,
sure.
We're seeing a lot more people that are coming to these investing classes want to learn more about different things. What are the opportunities that are out there? And I mean, think about this. I mean, you said these other markets like the futures and the Forex market, they're open 24 hours a day. Think about this. If you work during the day, you can still participate in these markets in the evening. A lot of people think they're stuck to the stock market and they can't trade and invest. Well, that's true because it's only open 6.5 hours a day. Now, with these markets, you have that opportunity. Now, coming up in this next segment, I want to continue this topic of common mistakes that the public makes. But a lot of people make a lot of mistakes in their retirement accounts, and sometimes they don't even know that because we're trained and conditioned to do things the wrong way. So coming up next, retirement accounts, and a couple common mistakes. This is Josh and Al. We'll be right back.